Ladies and gentlemen, good day and welcome to the Q4 and FY21 earnings call of Crompton Greaves Consumer Electrical Limited, hosted by Batlivala & Karani Securities India Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Kunal Seth from B&K Securities. Thank you, and over to you, sir.
Thank you, Malika. I would like to welcome the management of Crompton Greaves Consumer Electrical on the call and would like to thank them for giving us this opportunity. From the management team, we have Mr. Shantanu Khosla, the Managing Director, Mr. Matthew Job, Executive Director and Chief Executive Officer, Mr. Sandeep Batra, Chief Financial Officer, and Mr. Yashwant Regev, Vice President, Strategy and Financial Planning. I will now request Mr. Shantanu Khosla to give us some opening remarks, and then we'll open the floor for a Q&A. Over to you, sir.
Thank you. Good morning, everyone, and thank you for dialing in to our analyst call for the quarter. Firstly, I hope all of you and your family are safe and healthy during these extremely challenging times. As always, and as has been for now more than the last year, health and safety of our employees continues to be our number one priority. The infection count among our employees, unfortunately, in this wave has been higher as compared to the previous one. We are extending all support required to all our employees as well as their families. We have set up unit-wise WhatsApp groups with senior members to assist with COVID-19 related emergencies, and these groups have actually been extremely successful in helping us manage on the ground individual logistical challenges such as hospital beds or oxygen availability, etc. Our focus to curb the virus has also been to strictly follow work from home policy for all our offices, which we have been doing since the first half of April. We are tracking vaccination very closely among our employees and in every way helping and encouraging them to get vaccinated as soon as possible. Up till now, 508 of our employees have received their first dose. Greater than 80% of employees above 45 years of age have been vaccinated. We have collaborated with hospitals and 1mg to organize camps and are continuing to do so for the 18 plus year segment as vaccinations become more available. We will, of course, bear all the costs of this vaccination program for all our employees and family members. We continue to stay closely in touch with all our employees and have been conducting regular town hall meetings to address concerns and identify areas where we as a company can help our employees and our broader stakeholder community through this crisis. Moving on to the business and a few comments on the business. Overall, in the quarter, our business momentum continued its upward trajectory in the quarter. We witnessed robust growth in all months of Q4 over the corresponding period last year, and this growth was broad-based, with all our product categories, geographies, and channels logging strong growth. Our ECD portfolio continues its stellar performance driven by all segments. The lighting B2C segment has continued its growth momentum, which is driven both by volume and also value. The one segment of our business which continues to face some challenges is our lighting B2G, business to government, which largely is our key street light business, and this continues to be challenged due to slow uptick from ESL and government orders in the quarter. The other challenge, of course, has been commodity headwinds. We have taken 2 price increases in tranches. Despite our pricing action taken over the last few months, we have only been able to cover part of the hike in commodity costs, which is continuing to build up pressure on material margins. The commodity price escalation is unprecedented, as I mentioned before, and during this quarter, commodities were sequentially up by about 12% versus quarter three, and this has continued unabated with over April and May commodity prices up a further 8% versus Q4. Obviously, our cost-saving program, Unnati, which has delivered such fantastic results on a consistent period, continues to be a key program. We have saved approximately 60 crores under this program in this quarter. Our focus on efficient management of working capital has helped us further strengthen our cash position to 1,373 crores. We have maintained a healthy balance sheet and cash position, which, as we had said last year during the same time, we believe this will help us stand relatively better than a lot of our competitive set. We are best placed to tide over future uncertainty, aggressively ramp up once things normalize, and also ensure that we continue to invest in the long-term development of our business. We continue in this period to invest in development of R&D capability, alternative channels like rural, MOR, and e-commerce, the benefits of which have started showing results, and long-term results will be realized even more over the years. We remain committed to develop innovative consumer meaningful products that offer superior value proposition flowing both into the top and the bottom line. Moving into a brief overview of our segment-wise performance. Here, just to clarify, we don't normally talk about this, but I will also, to help provide perspective given the base period, talk a little about our sequential growth quarter to quarter and also January-February growth. This is simply to provide some additional perspective to all of you, given the March base period issue of last year. Our ECD business continued its momentum and delivered a 15% sequential growth quarter on quarter. In this quarter, our fans business grew 59%, growing close to 30% in January, February alone, on the back of strong performance across the entire range and product portfolio. Our strategic focus on premiumization continues, with premium fans delivering 76% growth and premium decorative fans delivering 72% growth. Our entry into the super premium fan segment also continues to gain traction, with business momentum improving sequentially. Our range of new offerings over the last couple of months has been received well by the market. In the rolling 12-month period, we have gained 1 point of market share in the overall fan business. Our pumps business witnessed a 61% growth, with Jan and February growth at 18%. Both residential and agro pumps witnessed value growth of 64% and 53% respectively. Our renewed focus on building a leading appliance portfolio continued to deliver exponential growth of 74%. Jan-Feb, 40%. The growth was driven by all our key focus choice segments. Air coolers grew 74%, geysers 87%, mixer grinder 81%, and irons 86%. Moving on to lighting. Lighting business continued its Q3 momentum, and the B2C business delivered about a 10% sequential value growth. Lighting revenues were 329 crores, registering a 15% growth over last year. However, the critically strategically important B2C LED business continued its growth trajectory with B2C LED value growth of 41%. As I mentioned earlier, lighting B2G was down significantly as the business faces major challenges due to slow order pickup by the government and EESL. With capacity ramping up, cost-saving initiatives delivered the desired results, and sustained growth in our B2C business has helped maintain lighting EBIT margins at double digits in Q4 at 16%. Very importantly, after the past few years of price erosion in lighting, which, as you're all aware, has been an extremely turbulent period, prices, especially in the key B2C segment, have largely stabilized, and category structural profitability has now been restored. On the supply chain over this quarter, all our factories are up and running. Productions of fans in our in-house units is 55% higher in Q4 over corresponding period last year. We are fully followed down all the safety norms and more laid down by the government, and social distancing is continued to be strictly adhered to in all our factory premises. The continued momentum of our business gives us confidence that our key strategic choices are working to deliver superior results. In spite of the challenging environment, we continue to invest in these areas. First, on go-to-market. Our superior partnerships with trade partners, where we have been empowering our channel partners to help them grow their business and continue to support them during these tough times, has resulted in continuous improvement in monthly billed dealers, reaching a record level in March. We are focused on improving reach. We have been making continuous efforts to improve the number of retail points where our products are available. Our fans rolling 12 months reach has gone up by 3.3 points. Secondary sales tracking, which is a backbone of our new go-to-market, through the information gathered from our tally patch, has enabled us to make more informed decisions and improve productivity and effectiveness of our program. Our tally patch now covers secondary sales data of greater than 80% of our total business. We are also continuing our focus and investment to harness the potential of rural channels, and that has been paying off handsomely for us. Our rural sales delivered exponential growth of 117% in Q4, 72% in the Jan-Feb months over the same period last year, and growth of 60% sequentially. We continue to gain share in this critical opportunity market. Our presence in channels like e-commerce and MOR, along with meaningful consumer engagement, has helped us deliver growth of 85% in Q4, 25% in January and February. We continue our consistent market share growth in this channel. Driving premiumization stays a critical strategic choice of ours, and which we had identified a few years ago, and it continues to drive our business. Our premium fan segment, as I had mentioned, grew exponentially by 76% in Q4 over the same period last year. Super premium fans volume has doubled as compared to the same period last year. Our investment in consumer-centric product innovation continues. For us, we have to be the leader in developing products that are meaningful to consumers, futuristic in design and application. Our revamped portfolio in appliances is clearly being rewarded with exponential growth, while our broad range of product portfolio in fans, lighting, and pumps have helped us gain market share year by year. Even this year, where we have been continuously hit by the COVID pandemic, we have continued to invest in introducing a range of new products across all our categories, with more than 30 strong new product innovations having been launched across our categories. Moving on to talk a little bit about the current situation. With ongoing COVID second wave in India, clearly, which is far more virulent and penetrated much deeper as compared to the last one. Previously, the virus largely was spreading in urban towns and cities. However, this has expanded to go deeper into rural India. Even though there has thankfully been a reduction in case count over the past few days, we still are very much within the peak of this pandemic. While restrictions had eased in Q4, and that resulted in a strong performance, from the back end of April through the whole of March, we are seeing essentially the entire country and most retail markets in a state of lockdown. These closures started impacting the business in the second half of April and have essentially led to a complete shutdown through May. The situation in April and May is really not very different in terms of market closure as compared to March and April last year. Depending on the extent of improvement in circumstances, we believe we can expect a gradual return to normalcy in Q2. This is again similar to what we saw in the last year wave. We believe that the demand recovery would follow like it followed last year, post reduction of COVID cases and ease of restrictions. As we were last year, we believe this year we are equally well positioned to go back with a vertical startup as we see markets opening, hopefully through the second half of June. The second key dynamic which I would like to just touch upon is commodities. As you're aware, all key commodities are currently at unprecedented levels. This increase has happened in an extremely short span of time. As I had mentioned earlier, in Q4, we saw a 12% increase in our overall commodity prices as compared to Q3, and this is not easing off. We have continued to see about an 8% increase through April and May. As we've talked before, our focus on recovering on commodity prices is based on three key areas: premiumization, accelerated cost savings, and pricing actions. While obviously, as I mentioned, we are doing very well on improving our mix and also on our accelerated cost saving Unnati program. That being said, these commodity prices are unprecedented. So pricing, as we have done in the recent past, will continue to play a key role. However, all that being said, we do expect continued margin pressure over the next couple of quarters. Finally, to just take you over through the final numbers, the Board of Directors at its meeting on March 21st approved quarterly results of the company for the quarter ended 31st March. Total income for the quarter was 1,522 crores. ECD revenue stood at 1193 crores, EBIT margin at 18.1. Lighting revenue stood at 329 crores. EBIT margin expanded by 840 basis points versus corresponding period last year and stood at 16.1%. Improved operating leverage due to ramp-up in activity in this quarter aided EBIT. Material margin stood at 30.8%. PBT stood at 231 crores versus 137 crores last year, growing 69%. PBT margin stood at 15.2%. Profit after tax for the quarter was 249 crores. However, this included an adjustment for the impact of an IT assessment order. Like-to-like PAT, after taking that into account, grew 63.5%. With that, I'd like to stop and address any questions that you all may have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ravi Swaminathan from Spark Capital. Please go ahead.
Hi, sir. Congrats on a good set of numbers.
Thank you.
My first question is with respect to the price increases that we have taken across each product. If you can do a broad overview, it would be good. And secondly, I mean, many of these price increases would be really steep. So, suppose all these lockdowns are lifted, do you think, what's your view on the elasticity of demand while you're juxtaposing the price increase that is likely to be there? So, basically, can demand take a hit to an extent because of all these price increases? If you can give a view on that, it would be great.
Yeah, Matthew, you want to take that?
Yeah. In terms of the price increases, we have already taken around 2 rounds of price increases already. One in around January, February, and one in May actually, April, May. So I would say the price increases between January and May, the two rounds, or in some cases in 3 rounds, the prices have increased by roughly 10%. On an overall, 8 to 10%. Now, obviously, the first round of price increase happened in February. So, at that point of time, we did not see any significant slowdown in demand, and that's what you see in the numbers for the last quarter. Now, in this quarter, the price increases have been announced and implemented effective April, May. Now, it is very difficult to predict, what kind of impact that would have, because now at the moment there is lockdown, so we really do not know, if and what kind of impact it could have on the demand. It is almost impossible to predict. The fact remains that the commodities are in a major bull run, and I think there is no other choice but for all the players to take some level of price increase. Typically, one round of price increase does happen around this period every year, but of course we have had this time one round already before that. So that how that will impact is very difficult to predict.
The only thing I'd add to what Matthew said is this commodity doesn't just affect us; it affects the entire industry. So it is leading brands with stronger go-to-market who tend to come out better in these situations. So I think the strength of our brand, the strength of our go, plus the fact that we're continuing to invest in innovation while we're doing this, will enable us to emerge, relatively speaking, in a better situation.
Got it. And in terms of other costs, especially ad spends, etc., how much ad spend we had done as a percentage of top line the entire year, and how is it likely to be over the next 2 years, if you can give a view?
Over the next 2 years, obviously this year there was a reduction in ad spend because in the summer quarter last year, we had cut back on spending due to the first wave of COVID. This year, however, in the summer quarter, we have continued to invest some amount because we were on IPL, etc., but not at the same levels that we would have normally invested. Moving forward, once we get back into normalization, we would expect the ad spend levels to continue to increase.
Will be on par with FY19 levels, sir? FY19-20?
To be fair, you just move on to someone else. I mean, I don't want to cut you short, but just to give everyone a chance, and then you can come back and feel free to contact us separately if you want more details.
Sure.
Thank you.
Thank you. The next question is from the line of Mayur Patel from IIFL Asset Management Company. Please go ahead.
Hi, gentlemen. Congratulations for robust results. And just want to highlight that it's really heartening to see the very transparent commentary from your side and with some numbers in terms of margin pressure and commodity prices.
Mr. Patel, so this is the conference operator. There is a slight airy disturbance coming from your line, sir.
Yeah.
Hello?
Yes, sir, you may go ahead now.
I think he's dropped off. Let's move to the next question.
Yes, sir. The next question is from the line of Ankur Sharma from HDFC Life Insurance. Please go ahead.
Hi, sir. Good morning, and congratulations on the great numbers. Just had two questions. One on the fan industry, so if you could just talk about, what would have been the growth or the degrowth we would have seen for the industry overall for FY21, and also what would have been similar numbers for Crompton. The reason I asked this question is to understand the kind of share gains we may have had, either from the unorganized or because of our own, efforts in terms of new product launches and premiumization, etc. And more importantly, the share gains from unorganized, do you think that can sustain or even accelerate with the second wave?
On share, like I think I talked before, we measure share based on consumption share from retail audit data, a third-party retail audit data. Based on that data, that's the share we report. On fans over the past 12 months rolling period, and the latest data is as of March, we have gained 1 point in share, market share. We are the largest share gainers in the category. This share gain has largely come not from unorganized players as such, but people who have got very small brand positions in the fans category, even though they may be organized players with a major player in some other electrical categories. So we are gaining share the fastest in this category over the past 12 months.
Okay. Yeah. Okay. Fair. And so anything on the overall industry growth versus our growth for 21, if you have those numbers?
Yeah, obviously. Yeah, Matthew?
Yeah, obviously, like we have mentioned in the previous calls, I think in the first half, the market was obviously declining. But if I look at the last 2 quarters only, let's separate the year into 2 halves, because the growth first came into the market only in the second half of the year. So in quarter 3 and quarter 4, the market pulse data shows the market has roughly grown around 9 to 10%. And obviously, we have grown much faster, as you have seen. In the last quarter, our fans growth was also around 30 to 40%, and this time again, it's pretty strong. So, and that's how we have continued to gain share, as Shantanu mentioned. Yeah.
Thank you. Ladies and gentlemen, please limit your questions to one per participant. The next question is from the line of Mayur Patel from IIFL Asset Management Company. Please go ahead.
I just want to thank you guys for guiding us in an extremely transparent way in terms of the margin pressure and the commodity prices. And Matthew was the first person and the only person in the sector in the conferences in February to highlight this trend very clearly. Maybe was painting a very rosy picture on the margin. So thanks a lot for that. Just one clarification I wanted. This 8% increase in April and May, is it fair to say that we will either need to increase prices by 8% or through mix and cost reduction, the 8% has to be mitigated, or some part of that already you have taken a price hike in April? That's the only question from my side.
Matthew, I didn't catch it.
I will answer the question. As we mentioned before, in quarter 4, there has already been a commodity increase roughly to the extent of 12%. This is in quarter 4. In April and May so far, the commodities have further increased, and so there's another 8% impact. So obviously, the impact so far in terms of from Q4 from now, because of the commodity inflation, is roughly 20%. Now, obviously, as I mentioned some time back, in between 2 to 3 rounds of price increase, I would say 10 to 12% out of the 20% has been passed on to the market. Now, like I mentioned, and like Shantanu has mentioned in previous calls as well, the mitigation of the commodity increase has to happen through the combination of one price increase, of which I mentioned roughly commodity has gone up 20% within these 5 months, and through price we have passed half. Okay, and the other 2 levers, which is mix, and Shantanu also mentioned, for example, in the last quarter when fans grew, the premium fans have grown by a factor of 1.5 times the overall fans growth. So our overall fans is very strong. but premium fans have grown nearly 70%. So obviously the continued drive to improve mix. And number three is the Unnati program, the cost reduction program, which we have very successfully run for many years. Now, through a combination of these three, we try to offset the commodity increase. But I think what one needs to keep in mind, it is not going to be possible, or it is not even the right approach to try and negate on a quarter-on-quarter basis. Our intention and objective is to retain our profitability, not in a quarter-to-quarter, but in a way that sustains our top-line growth while getting our margins back to normal levels within a 2 to 3 quarter kind of a framework. That's how we should. That's how we have been approaching this, and that's how I believe we should be approaching this. Not trying to offset on a month-on-month or on a quarter-on-quarter basis.
Thank you. The next question is from the line of Siddharth Behera from Nomura. Please go ahead.
Yeah. Hi, sir, and thanks again for the opportunity and on a good set of results. Sir, my question is on the ECD side of the business. We have done really well on the new product launches in the past, like geysers, and also going ahead for FY22, if you can possibly highlight some of the new product launches which are looking to do, and given that the second wave of COVID has come, so any change on the timelines side, if you can highlight, it would be really great to understand how this part of the business shapes up going ahead. Thanks, sir.
Okay. First, in terms of COVID impact, yes. Right now, in April and May, the markets are shut. So there is a short-term impact in terms of the timeline. But like I mentioned earlier, given the strength of our balance sheet and our long-term commitment to investment in our business, we will continue, like we did last year, to invest in the appropriate superior new product introductions across our appliance range as the market opens up, just like we did last year. Now, we have had great progress in our appliance program over the last 12-18 months. But we still have huge opportunity for growth. We have made significant improvements in our share position in geysers, which we started the earliest, but we have literally just begun filling in the gaps in our portfolio, putting the right high-quality, superior value propositions in various segments like mixers. So there is a lot of new product innovation planned in the existing categories to continue to gain our market share. We are still very low on share in small kitchen appliances, and we will continue to drive that. And we see a lot of headroom for share and revenue growth, just like we did in geysers.
Thank you. The next question is from the line of Ashutosh Garud from Ocean Dial Asset Management Company. Please go ahead.
Yeah, hi. Am I audible?
Yes.
Yeah. So my question is, last year in Q2, Q3, and even in Q4, we have seen a market share gain because of the ground level difficulties from business angle for many of your competitors as well. So having said that, we are again into the second wave, and even the commodity increase aspect has kicked in. So how do you see would this be beneficial for you to further gain your market share, accelerate it basically? I think someone else in the call also briefly mentioned about it. Going ahead, do you see from a market share angle, gaining angle, helping you for a volume growth from Q2, Q3 angle quarter?
Sorry to interrupt, sir. Mr. Garud, I would request you to mute your line while the management answers your question. There is a slight airy disturbance coming from your line.
The simple answer to your question is yes. Like I mentioned, I think a little earlier, as the markets open up, we have learned, and we successfully did it last year, in terms of an ability to quickly have a vertical startup faster than most of our competition. We believe that as the markets open up, that learning will stand us in good stead, and we will be able to open up quicker than most other players. Secondly, during challenging times like this, and this is a scenario which is even more unique than last year because there are challenging times both on COVID and the lockdown and therefore demand, but there are also challenging times in terms of the significant commodity price increase. At times like this, we believe that the investments we have made in our processes, systems, and capabilities, the investments we have made over this period in our people and our brand will enable us to come out stronger than most of our competition.
Thank you. The next question is from the line of Sonali Salgaonkar from Jefferies, India. Please go ahead.
Thank you for the opportunity. Sir, could you quantify our current distribution strength pan-India and also the breakup of rural versus urban? And lastly, your thoughts on utilization of robust cash on your balance sheet and capex if any. Thank you.
Okay. Matthew, you want to take the first one? And then...
Yeah. In terms of our distribution, we measure it by what we call reach. If I look at, let's take fans for example. In fans today, we this year during the entire financial year, we improved our distribution reach, availability of our reach of our product fans by almost 3 percentage points. So we are today available in almost 55% of outlets. This is by far even within the year the biggest gain in terms of driving reach improvement has been by Crompton, and that's one of the primary reasons where we have also got a significant improvement in share. Now, if I look at other categories, for example, in water heaters, where we have been rapidly gaining share, also our reach has almost grown by 60%. In the last 18 months. In lighting, our reach is only around 30%, and that's an area where we intend to focus as we go forward. Sandeep, you can take the question on cash.
Yeah, sure, I'll take it. So we, our business model remains quite asset light, and with negative working capital, the business is being able to convert over 100% of the profit before tax into cash, and that gives us amongst our peer set the most healthy balance sheet, and that certainly has come in very handy in these disruptive times, because we've obviously ensured that in times when market is disrupted and our collection cycle gets disturbed, we've ensured on-time payment to all our vendors, and a large number of our vendors are micro and small and medium enterprises. Having said that, obviously, beyond a certain point, we do not want to keep idle cash. The objective is to reinvest that in the business. I think as had been referred earlier or has been mentioned in one of the earlier calls, we remain on the lookout for inorganic opportunities, which we will be pursuing. So that would be the first and the best way to reinvest and redeploy the cash. And in case over a period we are not able to close any such a transaction, we would look to give it back to shareholders in the form of dividend or some other way.
Thank you.
Yeah.
The next question is from the line of Bhavin Vithlani from SBI Mutual Fund. Please go ahead.
Thank you for the opportunity and congratulations for great set of numbers. Mike, quickly on the appliances portfolio, and within that, in specific air coolers and mixer grinders, I would appreciate if you could answer my question into two parts. One is in terms of new products and the gaps that you have filled, and second is in the reach. And how are we seeing the ramp up? And also related here, last year in the same time, you highlighted because of the COVID when shutdown, investments in air coolers was decelerated.
Yeah, Matthew, you want to take that?
Yeah. So like as you know, we have picked three categories to focus on to grow our appliances business. One was water heaters, air coolers, and mixer grinders. Of course, the first one we took off was water heaters, and that's why as I mentioned before, we moved from being number 6, number 7 to being number 3, and close to being number 2 in water heaters. In air coolers, I would say the journey is roughly 12 to 18 months behind what it is in water heaters. So if I look at the last 18 months, or even 24 months, we have been the fastest growing company in the air coolers business. Last year a lot of our business was driven through a range refresh in desert coolers. Unfortunately, last year, of course, during the peak period, we had the COVID impact, which meant that we could not get the full impact of the introductions we made. This year, we have expanded that the range enrichment from desert coolers also to tower coolers and personal coolers. So now we have a fully enriched range across the entire air cooler category. Now, however, of course, this year again, as you know, April, May is peak period for air coolers, and the lockdowns have impacted even this year as expected, like it impacted last year. But for us, I think it does not change our long-term strategy on air coolers, which is to drive growth through offering differentiated propositions. That's one. Second, in terms of mixer grinders, I would say in the last 6 months or since the end of May 1, we have been doubling our mixer grinder business. But in mixer grinder, we start from a very low base. We have a low single-digit share. So even with doubling the sales, it's not good enough. So we have a full-fledged product program in place. The objective is to revamp our entire product portfolio in a period of 12 to 18 months, like we did for water heaters and air coolers. So I think mixer grinder is also following the trajectory, and our objective is to get disproportionate growth in all these three categories going forward. Yeah.
Thank you. The next question is from the line of Ade Mehta from Motilal Oswal. Please go ahead.
Hello, sir. Just a bookkeeping question. In terms of tax write-backs, how much amount do we have available for next year or so?
Sandeep?
So these are, we have taken a certain position in our tax returns and in our accounts, which we wanted to get validated or confirmed during the assessment process. And it was, so I think, so in our books, we did not consider the benefit, and only when it was finalized or considered by the tax authorities on a year-on-year basis, we have written back that tax component. Bulk of that is done. I think only one more year would be left.
Thank you.
Yeah.
The next question is from the line of Keyur Harish Pandya from ICICI Prudential Life Insurance. Please go ahead.
Thanks for the opportunity and congratulations for good results. Sir, my question is on, so if you can just give more idea about how the April and May have been for us, and just want to ask that how the inventory in the channel would impact the recovery for our primary sales. I mean, what is the situation of channel inventory? Is it high considering that we have done quite a good sales in Q4?
Matthew?
Yeah. Obviously, if you are going to compare with last year, okay, because let's compare with last year. You're right. Last year, in the last 15 or 20 days of March, there was no sales. And it was shut down, and typically the second half of March, or actually the whole of March is a period when there is significant, loading of inventory in the trade, as the trade, loads up inventory in expectation of April, May sales. Last year it did not happen because of the lockdown that happened in March. This year in March, the sales was good. Both the sell-in and sell-out was good. So if you ask me on the 1st of April this year, obviously the stocks are slightly higher than what it was last year. But if you consider a year before or a normal year, the 1st of April inventory is not high, but compared to last year it is high. So if you ask me, when the pandemic, when the wave 2 subsides, Is the pickup in primary sales going to be as sharp as last year? It's difficult to say because it also depends on the underlying demand and how the underlying demand comes back. So there is, but of course one needs to factor in the fact that the trade stocks are higher than last year. But eventually, how the subsequent months will play out will actually depend only partially on the opening stock of the channel. It will more depend on how the demand comes back eventually, because otherwise it's just a question of 15-20 days here or there. So that's something on which the trajectory of the next few months will be determined. Yeah.
Thank you. The next question is from the line of Shreyash Bukhanwala from Canara Robeco Mutual Fund. Please go ahead.
Thanks for the opportunity, sir. So my question was on the lighting margins, which we have delivered this quarter, around 15.5%. So what has driven that, and how should we look at it on more sustainable basis?
I'll let Sandeep take that, but just one point before Sandeep takes it. As far as the lighting margin goes, we need to recognize that the past few years was extremely turbulent as there was a huge amount of price erosion, which was supported over time by cost reduction also. That price erosion, especially on the B2C segment, has largely stopped. And as the costs continue to come down, the margins are improving. Right? So that's what I mentioned, that now with the price erosion on B2C largely stopping, this critical strategic category's fundamental structural profitability has been restored. Right? So that's a very positive thing for, I believe, for not just us, but for the industry as a whole. Sandeep, you got anything more you want to add on the margins?
No, I think you've covered it very comprehensively. And we see no reason why margins should, while yes, they're not going to hold the same line, but structurally, double-digit margins are very much sustainable in lighting.
Yep.
Thank you. The next question is from the line of Rahul from Haitong. Please go ahead.
Yeah, hi. So firstly, congratulations on good performance in the quarter. You've given a lot of segmental information for the fourth quarter. Could you, give the revenue breakup of important categories like fans, appliances, pumps, LEDs, for the full year?
Sandeep, do we share that information?
No, we don't share that information. We can, so that information, I'm sorry, we will not be able to share detailed breakup of the categories below the segment.
Thank you. The next question is from the line of Renu Baid from IIFL. Please go ahead.
Yeah, thank you for the opportunity and congratulations for the strong results. My two questions are, firstly, since you mentioned that among the other segments, lighting is a segment where the reach is lowest. So would it be right that the next M&A should be expected in the lighting segment largely to expand the reach in the market share? And if so, do we have any timelines or any prospects on cards for this segment? Also, what would be the kind of cost savings from Project Unnati that we're targeting for FY22? Do we have any broad numbers or targets for this category as of now? Or for this savings as of now, yeah.
Renu, on the first question, obviously I can't comment. It's not appropriate for me to comment. On the second, Unnati, Sandeep?
So our target this year would be around, obviously the target assumed normal year would have been around 175 crores of savings.
Yeah, 175, correct.
Yeah. But that assume, as I said, a normal year. If few months are going to get washed out because of lockdown, then that target will have to be suitably recalibrated.
Thank you. The next question is from the line of Achal Lohade from JM Financial. Please go ahead.
Yeah, thank you for the opportunity, sir. One question is with respect to market share, if you could give the market share we have in fans, pump, lighting and appliances, sir. And secondly, just a clarification on the cost savings in Unnati. What are the key heads here where we see the cost reduction, sir? If you could comment on that as well, that would be very helpful. Thank you.
Okay. Matthew, you want to take that?
I couldn't hear properly. Can you repeat?
So with respect the first one was market share in the subcategories. And the second question was what are the broad heads in which we're getting cost saving in Unnati?
Okay, so market share in appliances you asked, right?
In the different categories, fans, appliances.
Okay. Sorry, my sound is not a little clear. Okay, anyway, in fans and pumps, residential pumps, we have market share of roughly 27-28%. Now again, if I look at lighting, the market share is lower. The B2C LED market share is only around 8 to 10%. In that range, depending on which quarter you're talking about. In appliances, of course, in water heaters is the one in which we have roughly 15% market share. In the other categories, which is mixer grinder and air coolers, our estimated market share is in single digits. In Unnati, of course, the cost saving is on different heads. I think the biggest saving is still in terms of the product costs. The product costs are primarily, there are different levers on which the Unnati has delivered multiple year results. One is in terms of what I call some level of product redesign. So that would mean, for example, use of alternate materials. That is one option, one lever. It could be redesigning the product in terms of eliminating those features for which the consumer doesn't see any value. So eliminating what I call non-value added features, which actually add a cost but doesn't add any meaning to the consumer. Number 3 would be negotiating better. So one of the things we have done over the years is to set up a central purchase organization so that we can negotiate as one company rather than as 4 businesses. Looking at alternate vendors where it makes sense. Looking at alternate country sourcing where it makes sense. That is one set of costs. Second one is optimizing the processes within the sourcing locations and the factories. How do I make our factories and our co-partners more efficient in terms of manufacturing and so on and so forth? So the whole gamut of costs. Then there is also an indirect cost. So can we have our logistics costs more efficient and so on and so forth. So I would say pretty much every element of cost is being worked on. That's the only way we can have 5 years of such huge savings. So that's how that is proceeding.
Thank you. The next question is from the line of Ashish Jain from Macquarie. Please go ahead.
Hi, sir. Good afternoon. Sir, my first question is again on Project Unnati. So, if I go by the number you indicated, 175 crores, that if I look at it on a second half revenue basis, that translates to roughly 1.5-2% on margin. So if not in fiscal 22, do we have fairly high visibility that maybe with a lag of 3 to 6 months, this is low-hanging fruit for us?
Well, see, you're right. Our ongoing goal on Unnati has been to save about 1.5 points every year. However, it is important to realize that this then gets reapplied in different ways. For example, part of it definitely gets reapplied against commodity inflation. Part of it gets reapplied in greater investments in capability and brand building. If you think of our business over the years, we have made significant investments in almost every area of the business. The investments, for example, which we're making today in building our R&D capability or our go-to-market capability, all of this is reapplication of savings which we are creating through the Unnati program. So that continues unabated. In fact, given the commodity increases, we double down and try and accelerate some of that. but it's not right to necessarily assume that this will all flow into margin. No. This is, if you will, the source of funds for investing in our business and brand growth.
Thank you. The last question is from the line of Srinidhi Karlekar from HSBC. Please go ahead.
Yeah, hi. Thanks for the opportunity and congratulations on great set of numbers. Sir, I just had a question on fan industry demand coming from rural India. According to your assessment, sir, how much of the volume demand of fan comes from that 6 lakh villages we have? And how is the demand, like in terms of brands, is it very different what a rural villager buys compared to, say, tier 2, tier 3 town customer?
Matthew?
Yeah, see, look, so in terms of, our penetration into the rural market, to be honest, is very limited, okay? Bulk of our sales comes from the urban markets and more so from the towns which are 1 lakh and above, okay? Now, our current, when we say rural or urban, distribution expansion, we are basically talking about expanding, the reach of our products to towns which are 10,000 population to 1 lakh population. Okay, so I would say still largely urban, but maybe we might just touch the higher end of the rural area. So I don't think we are really talking hardcore rural to that extent. But what we have seen, at least in the lower tier of urban markets and the bigger towns, we don't see a significant difference in the kind of products that sell. Because I think that expectation that what sells in rural or urban is only the lower specification products is not really borne out by data. So we don't think that a significantly different portfolio will be required to satisfy to cater to the demand in urban markets. Yeah.
Thank you. I would now like to hand the conference over to Mr. Shantanu Khosla for closing comments.
Thank you. Thank you so much. Thank you for taking the time to join the call. As always, our objective in these calls is to try and be as transparent and open as we can to give you a better understanding of our business and how we're looking at our business. As always, if you've got, any questions in terms of follow-up or we weren't able to get to, please feel free to contact any of us. We'll be more than happy to address them. Finally, please stay healthy, stay safe, look after your families. That's the most important thing. And if you have the opportunity, get vaccinated. Thank you so much and take care.
Thank you.
Thank you, sir. On behalf of Batliwala and Karani Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.